So, we all know that stock prices go up and down every single trading day. That's just how the stock market works. But what a lot of people don't realize is that dividend yields also change every day, and that's simply because of how they're calculated. In this video, I'm going to break down how dividend yield actually works, and I'll show you how to calculate it yourself. It's something that's definitely worth understanding, although it's not always as big of a deal as people think. When I first got into investing, I used to believe that if a stock had a 5% dividend yield, that meant I'd always earn 5% in dividends no matter when I bought in. But once you really understand what dividend yield means, you'll see it's not exactly what most people assume. Dividend yield is just the current percentage of return you'd get based on how much the company is paying out in dividends compared to the stock's price right now. So let's say a stock has a 5% dividend yield, and you invest $10,000. That means, at that rate, you'd make $500 a year in dividends. But that only applies if you invest all $10,000 at that exact moment. If you wait a few weeks and then invest, the dividend yield might be higher or lower. It all depends on what the stock price is at the time. As stock prices move up or down, the dividend yield moves with it. So if you're looking into a company and see it currently offering a 5% dividend yield, don't assume it'll always stay at 5%. Since the stock price changes every day, the yield will naturally fluctuate too. Also, the company itself might change how much they're paying out in dividends, and that can have a big impact. For example, if they're paying $5 per share annually and then lower that to $2.50, that's going to cut the dividend yield in half. Now, dividends are always paid on a per share basis. So let's say you've got $1,000 to invest and the stock price is $100. That means you can buy 10 shares. If the company pays out $2 per share annually, your 10 shares would earn you $20 per year. That's a 2% dividend yield. But let's say you waited, and the stock dropped to $50 a share. With that same $1,000, now you could buy 20 shares. If the company still pays $2 per share annually, your 20 shares would earn $40 per year in dividends. That would be a 4% yield, double what it was before, simply because the share price dropped, and you got more value for the same money. This is why buying when stock prices are down can sometimes be more attractive for dividend investors, because dividends are based on the number of shares you own, and you can own more at a lower price. To calculate dividend yield, video dividend 2 parts.